Hey, we are back with another podcast, and this is Will Knight, your host of All About Nothing. And today, my co-host is
Brian Taylor. Thank
Brian.
you, Will.
Welcome back.
Thank you.
And we're talking about bonds today. We're doing this financial advisory or financial status checkup, and we want everybody to know about what can they do to increase their wealth and become your client.
Oh, that would be great.
So,
I'm just kidding. Thanks, Will.
No problem. So today we're talking about bonds. For someone who's new at investing, what exactly is bonds?
That's probably the hardest one to get your head around and to explain, but I think everyone knows what CDs are, or like a savings account, right? So CDs, you put your money in the bank, and they're going to pay a little bit of interest, but they're really using your money for other stuff, and they're paying you a little bit of interest. But that's straight up, usually guaranteed, FDIC insured, no risk, and they give you like a set guaranteed interest rate, right? Mm-hmm. So bonds is probably like the next step up. It has a lot of elements of safety, like downside protection, but you lose the FDIC usually. So it's not FDIC, and it's not really guaranteed.
Okay.
So stocks, like you own something, and if the company goes bankrupt, you can lose everything. But in a bond, you're kind of like, you're lending money. It could be lending money to the U.S. government. It could be lending money to municipalities like the city of Chicago. You could lend to Google. You could lend to all different types of entities, right? And if you're going to lend to them, or if you're going to lend your money to them, they better pay you more than a CD because that's guaranteed.
Right.
Right? And if you're going to lend money to Google, they better pay you more than the feds, because the feds are really good about just printing off money.
That is true.
They will pay you back, even if they don't have the money. I'm just kidding, but
we print more.
Right. So like the federal debt is like supposed to be the safest debt out there, but even though their balance sheets are garbage. But like Google has probably rock solid balance sheets, but they still have to pay you more to borrow your money because you can get it for free elsewhere, guaranteed, right?
Okay.
But you're lending your money to somebody, and they're taking your money, and they're just promising you to pay a stated interest rate, and it depends how long the loan is locked in, whatever. And sometimes they can sweeten the deal, and they can say, hey, if something happened to us, this loan is backed by taxpayer revenue, like property taxes or tollway bridges, or it can be backed, for a company, it can be backed by property, like computers, whatever stuff they own, like real tangible stuff that if they went bankrupt, they got to sell this stuff. Bondholders always get paid first. They get paid before any stockholders do.
Okay.
So there's a little bit of safety there, but it's still at risk. Okay. It's not guaranteed.
So how does bonds differ from stocks in terms of risk and stability?
So stocks can be all over the place. You can, especially if you're with like small little company stocks, but the big stocks, they, we could say their long-term averages are like 8 to 10% per year on average. But JP Morgan does a good study that says, if you look back at like the last 50 years of data, on average, stocks drop about 14% per year every year. It's kind of a big drawback, right? So let's say you have a portfolio grew to 100,000, it's all stocks in there. That portfolio could maybe regularly drop to 86,000. That's a big swing. Some people don't have the stomach for that. And some people can't afford to lose that much money because they might be taking monthly checks out every month, or they might be trying to buy a house. So bonds is like a great complement to stocks. You're not going to get the same return as stocks, but it comes with a lot more downside protection. I don't know if these numbers are accurate, so you have to research and consult too. But like bonds, maybe you'll average right now 4 to 6%. So it's definitely not 8 to 10%. It's a big sacrifice. By the way, if you only get like 5% per year versus 10% per year, that's a giant. That might be like 3 times the portfolio growth by being in stocks. So if you have a long time ahead of you and you're confident with the market, you should have some money in stocks, right?
Okay.
But the older you get, typically the more you start to lean into bonds for some downside protection. They kind of want to preserve what they've accumulated.
Yeah.
Or they might want to have like some short-term liquidity. Like bonds are a little bit more liquid than stocks sometimes. What I mean by liquid is like in a down market. If there's a recession, bonds usually bonds usually hold their head up in a recession. So a lot of times when there's a recession, bonds don't drop 10% like a stock does. They might actually be positive. How about that? Or they might be down like single digits. But there are a lot of factors that can change the price. Like 2022, the average bond was like down double digits. That's because interest rates went skyrocketing high. So you have to contend with that. But they are safer. I'm trying to think what the main question was. Why would they start adding bonds? I think you said, right?
No, why do bonds differ from, I'm sorry, how do bonds differ from stocks in terms of risk and stability?
Oh yeah, so they just have a lot more downside protection historically in times of recession, when the stock markets are down. A lot of times bond markets can hold their heads above water or be pretty resilient to the down markets.
Okay.
Where the stocks you're at the whim of the stock market.
So you cannot answer this question because as a financial advisor, Brian cannot answer some of the questions, but I will ask him this one. If he can't say it, he'll say I cannot answer that. What are some of the main types of bonds investors should know about?
You know what's funny is I don't think the average investor will ever own an individual bond. Like you're not gonna go buy a City of Chicago bond. They sell it that way. You can get it through like Morgan Stanley. You can get it through us. No one really does that. So bonds is one of the areas where there seems to be a lot of success in active management. So if you lean into a mutual fund, it's totally diversified. You don't want to put all your money on one bond anyway. Everyone likes diversification, so you want to have it spread out in hundreds, thousands of bonds. But bonds in general, like historically, if you have an active manager in bonds, not all of them, but a lot of them actually beat the indexes, like because they're able to kind of navigate the markets and tiptoe into different types of bonds that might be more likely to outperform during different times, and they can lean into more aggressive bonds. So the type of bonds, like there's a lot of different types of bonds we kind of talked about, but I am actually a big fan of just leaning towards letting the bond experts run that for me.
Okay.
You know, we do have a couple different types of bonds in our portfolio, but I kind of lean on the experts that have awesome track records, good performance compared to their peers. They have had good track record in down market years of doing what they said they were going to do, right?
Mm-hmm.
It's really complicated for me to like buy individual bonds and build that portfolio. But
Okay.
if you own an individual bond, you do not have interest rate risk. If you own a bond mutual fund, you do have interest rate risk. So in 2022, most people who held their bonds in mutual funds, because most people do, they lost money temporarily at that time. But if you hold an individual bond, you don't lose anything. You just have to wait as long as you wait till maturity, you get your money back. And that's true for all bonds.
You actually just answered my next question was, why do financial advisors often recommend bonds in a portfolio?
Yeah, that's their downside protection. So the more risky, aggressive you are, the less bonds you're going to have. You might have no bonds. The safer you are, if we can get you out of CDs, you might have all bonds. I had a down payment for a house in almost all bonds. I wouldn't recommend that for every client, but I was so optimistic in bonds, and it worked. It paid a lot higher than CD rates last year. At this current moment in 2026, I was pretty optimistic about bonds. But I also, if I'm trying to buy a house, I can't afford a 20% loss for a recession, and historically bonds usually don't fluctuate that much, so I'm at way less risk than the stock market. If that kind of makes sense.
Yeah, it does. I'm sorry to cut you off and jump to the next question, but because we hear a lot about this in today's economy when we talk about interest rate changes. Mm-hmm. How does that affect? I'm going to ask you two questions. One question, but it may be two answers. How does interest rate changes affect bonds, and how does it affect a client's portfolio?
Good question. So I'm going to pivot back to the last question for a second. So you said, why do we add bonds to the portfolio?
Yes.
So, for example, like bonds they're working harder than CDs. You're trying to get a big chunk of your money. You still want it to grow. You want to get that 5, 6, 7% return, maybe if you can get it. But let's say there's a full-out recession for 4 years. if all of your money's in stocks, and if Will Knight is expecting his monthly paycheck, I got to sell some stocks for you to give you your money. And I might have to sell, I'm picking on NVIDIA because we all know NVIDIA on the call today, right?
Right.
But let's say I sell NVIDIA and it's down 30%, that stings. You don't want to sell it at a loss, right? You want to wait till you wanted to sell it. But if I have bonds, I can be smart and I can say, well, I got your money for you for the next couple months. I'm just going to sell the bonds because hopefully the bonds didn't lose any money anyway and their head's still above water. So it allows me another place to grab money when markets are down, and it gives you less volatility in your portfolio, but it allows me a place to grab money in hopes that the market will rebound before you run out of bonds. That's a better answer for that one.
Okay.
But interest rates, how do they affect bonds? The way I can best explain it is like, I'm going to use a CD as an example because we all know CDs.
Yes.
But let's say you
And
bought...
CDs are certificate of deposits for people who don't know.
Right. You can get them at the bank and they truly are, they give you a flat rate, it's guaranteed, right? But let's say you buy a 5-year CD with Chase. Everyone knows Chase. Let's say they're promising you 5%. A couple years ago, when in 2022 interest rates were high, some CDs were paying that much. So let's say you bought a 5-year CD at 5%. You're locked in for 5 years. You should have been willing to hold it for 5 years. But let's say interest rates go down, and now interest rates are only 2%. But let's say Will needs his money back. You're 2 years in, new rates are 2. Will's got a nice 5-1, but Will wants to get rid of it because he needs his money. Well, your CD is actually more attractive. If you're trying to sell it to Bryant, if Bryant can only get a new 3-year CD, because you only have 3 years left, if a new 3-year CD is 2%, but Will's got one for 5, I'd be willing to pay Will a premium for it. I'll pay for his because they went up a little bit.
Mm-hmm.
I want to get his at a better rate. I'd rather get that 5%, right? So Will can make money when interest rates go up if his was paying lower. But if interest rates...
Okay, we had to take a little break, so go ahead, Brian.
But yeah, on the flip side, so let's say you lock it in at like 2% during COVID. They were nice. They were really low rates. You lock in a 5-year, and then it goes to 5%. I don't want Will's CD. Why would I buy Will's if I can go get a 5-year or a 5%? But if Will must get rid of his, I'm gonna say, sure, Will, I'll buy it off you, but I'm not gonna pay what you paid for. I'm gonna give you a discount, and sometimes it can be a decent discount. And the reason why I would do that is because I want what I paid for it plus all the interest he was getting to equal the equivalent of a new 5% CD. So when interest rates go up, bond prices temporarily go down.
Oh, okay.
Just like that example.
Yeah.
But if interest rates go down, like people are kind of thinking they'll stay or kind of go down a little bit now. If interest rates stay or go down, that's actually good for bonds. Bonds should actually recoup some of these losses they had the last couple of years.
Okay.
Bonds are a boring topic, everyone, we know.
What does bond maturity mean, and why does it matter?
Bond maturity is like, if you break it back, by the way, if you buy a mutual fund bond portfolio, in everyone's 401k, you have bonds, but no one has individual bonds. They're all portfolios, so we don't really care about maturity. You do care about duration. Duration is like the average length of the bond in that portfolio that's left before it expires. You want to know, it kind of tells you like how long these rates are kind of good for before they start moving, could move a lot, right?
Okay.
But maturity under the hood is like, okay, you bought a Google bond and they said it was a 3-year bond. Maturity is like when the bond ends, 3 years.
We're going to use Yahoo next as an example.
Yep.
I'm just messing with you. How can bonds help protect investors during market downturns?
Just a lot less volatility.
Okay.
Historically, not guaranteed, but usually a lot less downside. I don't have numbers in front of me, but like you don't see bonds drop 20%. That doesn't happen. But you see the market drop 20, 30, 40%. It's happened.
Right. Yeah.
So that's the main thing.
When should someone start considering bonds as part of their investment portfolio?
Depends on when you need access to your money again, right? So like for me, my house example, I need it to be liquid. I need to be able to access it whenever I want. So that's why I chose bonds at that moment.
Okay.
but it also is like the degree of risk you're willing to take. So if a lot of people get older, they get to retirement, they don't want to see a 20% drop anymore. So they want a little more stability, and then they increase bonds as they age, as they say.
What is the most common mistakes people make in investing in bonds? Or are there any mistakes?
I don't know that I see any mistakes in bonds that often. I see a lot of people that have a lot of money in cash at good old Chase making zero. When, like, a lot of people are nervous. I've seen it in mattresses under the floorboards, but those last two are not FDIC. The bank at least is, but the bank is usually they're not paying anything, very little interest. So we're trying to coach people, get them in, consider at least CDs, consider bonds, like for a portion of it, right?
In today's economic environment, how should investors think about the use of bonds effectively?
I think people are nervous right now too. So I kind of before last year, so I kind of missed some of the upside, but I kind of took a lot of profits because we've had a fantastic last 3 years, right? And before the election, I just thought the markets were really high. I was like, I'm just going to sell off some profits, and I didn't get conservative with anybody. I just went back to neutral. So I sold some profits and bought more bonds for people that had bonds in their portfolio. But why did I do that? Is kind of your question. It's just like, I don't know how much room is there to run in the current environment. You got China, Russia. Now Trump is saying things with Venezuela and Greenland. You got tariffs. You had COVID before. There's so much stuff going on, and there's always stuff. That's not reason to panic. Believe it or not, people are mostly optimistic right now.
Mm-hmm.
But I was just thinking, like, if you're trying to get more stable, kind of get back to ground zero and build a little more downside protection, that's why they might consider bonds.
Okay.
Yeah.
Well, that's about wrap this up. You want to give people your information and anything you want to say lastly before we cut this off?
Sure. Well, hey, I always appreciate being a part of the podcast. Thanks for having me, and nice to meet everyone in the community. If you ever have any questions, we're happy to do complimentary review. Just kind of look at what you got. We can give you thoughts, feedback as to how you might be able to improve or what you might consider. We're here to help. My name is Brian Taylor. I'm a certified financial planner with LPL Financial. We're in Chicago, and we're here to help. Thanks, everyone.
Thanks, Brian. I'll talk to you guys later. This is it for All About Nothing.